Welcome to this explainer. Today we're talking about the wealth multiplier. We are going to completely unpack the exact mechanics of how everyday folks just like us build some seriously substantial portfolios using a very simple, structured approach. Let's get right into it.
Okay, let's dive into this. How in the world do you build wealth with just 500 rupees? I know, right? It sounds almost like a trick question. We're always kind of conditioned to think that investing requires, thousands upon thousands of rupees just to get your foot in the door. But today, we're going to see how seemingly tiny amounts, literally the cost of a couple of cups of coffee, can actually be transformed into this massive, powerful financial engine.
So, the secret sauce to that 500 rupee question? It lies in the SIP, a systematic investment plan. Now, you've probably heard the term tossed around before, but today, I want us to look at it strictly as the ultimate, absolutely chill, automated habit for consistent saving. Instead of stressing out trying to scrape together this massive lump sum of cash to invest all at once, an SIP is simply the method that lets you deploy smaller amounts of capital consistently over a really long horizon.
The actual mechanics of how this works, they're beautifully simple. Step 1, you pick a fixed amount. Let's just say you decide, hey, I'm going to allocate 2,000 rupees a month. Step 2 is where the magic of automation takes over. You just set it to auto-deduct right from your bank account. It literally just happens in the background while you go about your life. And then step 3, that money automatically buys units of your chosen mutual fund. This whole automated loop just keeps running month after month after month until you actively tell it to stop. Now here's where it gets interesting. That automated 2,000 rupees, it buys those mutual fund units at what's called their net asset value, or NAV. But because the broader market is constantly moving up and down based on economic data and world events, this NAV actually fluctuates every single day. So your fixed monthly investment is continually purchasing an asset, but the price tag of that asset changes literally every day.
And this brilliantly illustrates a really fascinating dynamic. Think about it. Because your investment amount is locked in at 2,000 rupees, but the NAV fluctuates, when the market is booming and the NAV is high, your 2,000 rupees naturally buys a little less, fewer units. But, and here's the kicker, when the market drops, your exact same money suddenly buys a whole lot more units on a massive discount. This phenomenal seesaw effect, it's called rupee cost averaging. You are quite literally turning scary market dips into a bargain shopping sale for your portfolio.
And let me tell you, the psychological relief of this is just absolutely huge because rupee cost averaging naturally smooths out your purchase price over time. It completely cures the biggest headache in finance, trying to time the market. You do not need a crystal ball. There is zero pressure to predict the perfect, exact right time to jump in because your SIP is doing all the heavy lifting for you. It just keeps consistently acquiring assets straight through all the market's crazy highs and lows.
But listen, rupee cost averaging is really just the first part of an SIP. The second component, it is arguably the absolute most powerful engine in all of finance. We're talking about the power of compounding. Compounding is basically what happens when your money goes out, gets a job, and starts generating its own capital. You aren't just earning returns on your original cash anymore. You are actually earning returns on the returns that have already been generated over time. It's this incredible self-sustaining cycle. And the longer you let that engine run, the longer you just stay invested, man, the greater that multiplier effect becomes. Okay, to really lock this concept into our brains, I want us to imagine a simple, totally realistic scenario. Let's look at the 20-year journey of a really disciplined saver who decides to just put the math of an SIP to the test. Let's run the numbers on this. So our disciplined saver makes a commitment. They build this starting habit of investing exactly 5,000 rupees every single month. No excuses. They set up the SIP, the money auto-deducts, and they just let it run. Month in, month out, that 5,000 rupees is consistently deployed right into the market. Now, if you hold that line for 20 years, what is your actual out-of-pocket cost at the end of the day? Well, the simple math is 5,000 rupees a month times 12 months times 20 years. So your total principal investment, the actual cold hard cash that left your bank account, adds up to exactly 12 lakh rupees. That is a really solid baseline of capital just built from systematic saving alone, right? Right, so now let's introduce the variable of market growth. Let's just assume that over those 2 decades, riding through all the crazy macroeconomic cycles, this mutual fund earns an average annual return of somewhere around 12%. Now, obviously, this is just a benchmark for our example, but historically speaking, it's a pretty reasonable assumption for a long-term equity investment.
Now, what's really interesting about this slide is the absolutely staggering contrast between your input and your outcome. That 12 lakhs total investment, thanks to the magic of rupee cost averaging and compounding at that 12% average return, it could grow to roughly 50 lakh rupees or even more. Your money has literally multiplied itself several times over. And why? Simply because you gave it the structured system and the time it needed to compound.
I mean, look at that. This isn't some crazy financial wizardry. It's not a glitch in the matrix. This staggering wealth creation is really just the epic victory of consistent investing and compounding. It is literally just patience and math working perfectly together over the long haul. It totally proves that you do not need to be lucky to get wealthy. You just need to be exceptionally disciplined and just let time do the heavy lifting for you.
So, running through this playbook, the core benefits of this strategy are pretty hard to ignore. First off, it completely forces disciplined investing because, well, the automation builds the habit for you. It's also incredibly affordable. You absolutely do not need a massive bankroll to start. A lot of platforms let you get in for as little as 100 or 500 rupees. It actively reduces your market timing risk. It is totally flexible, so you can bump up your contribution when you get that big raise or maybe pause it if you hit a rough patch. And ultimately, it's just the perfect vehicle for hitting those major long-term life goals.
And really, the true beauty of the SIP is just its absolute accessibility. This is a tool built for everyone. I mean it. Whether you're a student trying to invest a little extra pocket money, a salaried employee carving out a piece of your paycheck, or a business owner dealing with completely unpredictable cash flow, this strategy adapts to you. It's custom engineered for normal, everyday folks who want to build wealth gradually without needing a massive lump sum on day one.
But before we wrap this up, we definitely need a quick reality check here, just to separate the vehicle from the destination. An SIP is not actually an investment product all by itself. It is strictly the automated delivery method. The mutual fund, that is the actual financial product. And because mutual funds deploy your capital into the real-world market, they inherently carry real market risk. So, the crucial point is this. While an SIP is an absolutely fantastic method for smoothing out volatility through averaging, the returns themselves are never, ever guaranteed. Markets fluctuate. That's just a fact. Therefore, it is entirely on you to choose your mutual funds carefully based on your own personal risk appetite. And honestly, more importantly, you have to remain patient. Panicking and pulling all your money out during a scary market dip, that fundamentally breaks the compounding engine we just talked about.
We've just seen how a simple 5,000 rupee habit can transform into 50 lakhs over 2 decades. But the one absolutely critical ingredient you cannot borrow, you cannot buy, and you definitely cannot hack is time. The math clearly works, but it literally cannot start without you taking that first step. So here's my question for you. What financial goal are you continuously delaying, and what is waiting another month actually costing you? Think about it. Thanks for joining us on this explainer today, and get out there and start building.